Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner and adjunct assistant professor at Purdue University. Consider This is brought to you by the Financial Enhancement Group, LLC, where Joe serves as managing partner. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Anderson, with offices in Anderson, Lafayette, Indianapolis, and Rensselaer, Indiana. This show is for educational purposes, and you're strongly encouraged to consult with your financial professionals for personalized guidance. Big Joe can be reached at 800-928-4001. You can find out more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Good morning and welcome to Consider This. I'm Joe Clark.
And I'm Sherry Contos.
Happy to have you along. Hope you are enjoying this wonderful Indian summer, as they like to call it.
Yeah, before the big chill.
Yeah, the big chill.
Yeah.
We don't even want to talk about winter.
Okay.
However, when the snow starts to fall, there's something that you need to keep in mind. When I used to play football as a nose guard, the coach would always say, he would refer to me as Clark because that's their way of talking. Mm-hmm. Said, Clark, you going to be a thermostat or you going to be a thermometer today? And a thermometer in his mind was was kind of like the game clock, the scoreboard. It tells you what is going on, and that for all intents and purposes is what we have every April 15th when we fill out our tax return and we pay the IRS their pound of flesh, many pounds too often. But it's the game's over at that point in time. The score is on the board, and there's not a lot you can do. The thermostat, on the other hand, changes the condition. A thermometer says here's the temperature. A scoreboard says here's the score. A thermostat changes the condition, and that's really what tax planning is. It's things that you need to be very proactive about to be able to change the condition of what is going on inside of the world, especially your tax world. And I tell clients on a regular basis, I will tell you, and I will tell everybody who listens, for most of us, there is nothing that will separate you from retirement dreams like the Internal Revenue Service. When I look at the failures, the pitfalls, the problems that people have at retirement, it almost always centers around that 1040 and the tax return. And the more proactive we can become at changing that condition, putting it in a more appropriate light, the better chance you have of having a successful retirement. Remember, when we went from defined benefits or pension plans to defined contributions like 401ks, 403bs, IRAs, when we made that adjustment, they gave you, each and every one of you, my job without the education and the training behind it. I'm a registered investment advisor. The firm is the Financial Enhancement Group, and I serve as a legal fiduciary. That means it's my job to treat your money as if it were mine and we were in the same situation. As a certified financial planner, doing this for 27 years, I've got a team of 17 people. All of a sudden, when we did the defined contribution plans, they gave you that responsibility that I have for so many people, like we would do if we were taking care of a pension, for instance. So there are 4 things you're always going to hear me talk about that I have to worry about for you if I'm taking care of your resources. It's risk and volatility, the normal ups and downs of the market, fees and expenses, and remember, they're 2 separate things. Taxes, but it's both today and tomorrow, just not right now. And last but not least is making sure that you get a real return on your money. That's something above zero plus inflation. We're going to try to bring all of that together. We don't do it in each and individual show, but we do talk about various things. So you've probably heard by now when the budget deal was signed, there was a major change that took place inside of Social Security. We're going to talk about that today with Sherry. And we're also going to get into what's going on with Phantom. Halloween's over. Yeah. Phantom capital gains. I'm Joe Clark. You're listening to Consider This. If you've got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com. I'll take a break. We'll be right back. Consider This with Big Joe Clark is brought to you by the Financial Enhancement Group, a Hoosier-based registered investment advisory with more than $150 million under management. The Financial Enhancement Group serves clients in 25 states and proudly takes care of people who don't want to worry about their own money. You can find out more about the Financial Enhancement Group at yourlifeafterwork.com or reach any one of our 4 Central Indiana offices at 1-800-928-4001. Your Life After Work. That's what it's all about. Good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. Speaking of happy to have you along, we're getting ready to put Sherry on her soapbox. So,
Yes.
She doesn't. She has an interesting feeling about changes.
I do.
And go ahead.
When the government does something major like changing rules for capital gains or Social Security or taxes or anything, it upsets me that a normal person, I don't understand how we're supposed to know that. I seriously don't. And I don't understand, we have $1 billion advertising agencies in this country. Why can't there be like billboards along the highway that just say, when something huge changes, we were talking off the air, 2,000 feet is such and such a store, 1,000 feet is such and such a store, 500 feet, blah, 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 blah. You dispatch the such and such store. Why can't there be billboards that build up and tell you what the changes are?
Why does it have to be a billboard?
Anything. Could be social media. Could be
So, Sherry, I get, on average, according to Vicky, who runs my calendar, 313 emails a day on average.
Okay.
Many of them are about those tax code changes. There are other financial analysts who are saying this or that about this or given stock or whatever else.
Yeah.
Do you really want to read the 313 emails?
No, I would like the condensed version.
But what's condensed for you and what's condensed for somebody else could be two different things. The bottom line is there was a major change to Social Security in the budget deal that will impact many of the people who are listening to the show.
And how would they know
there's
that?
How
would they know that?
The sad part is, it's my 70-70-70 rule, which my young people when they come into work at the Financial Enhancement Group, I share the idea with them, and they look at me like I'm crazy, and then after 6 months, they're looking at everybody else like they're crazy and then after a year, they get it. So the 70-70-70 rule is this: 70% of the money that you save in a tax-deferred retirement plan, like a 401k, a 403b, or an IRA, you tend to put in while you're married filing jointly. Now, pause. The reason that matters is from a tax standpoint, we all have money that is taxed at different rates. The first dollar that you make, that I make, that Warren Buffett makes is taxed at 10%.
Right.
So married filing jointly, we can make up to about $37,000 this year and be taxed at 10%. Filing individually, you're only at about $18,000 to be at that 10% bracket, and then you go from 10 to 15. Now, you may be thinking, Joe, 15 is not that big of a number. I call it a 50% increase.
Yeah.
It's why
it's a big number.
When people sit down and they, we want to hash over the difference between a 7% return and a 7.5% return or an 8, we focus on those 0.5% returns without focusing on a 50% tax increase. And by the way, after 15 comes to 25, that's 2.5 times larger than 10%. Again, it's why I say focusing on the tax part truly does matter. So when you look at this, 70% of the money goes into those tax deferred plans while you're married filing jointly. And that's, in my opinion, I can't substantiate that. I'm just telling you, 27 years of doing this, I've seen a few things, right?
Yeah.
What I will tell you is that 70%, this is fact, 70% of money does not come out of those plans until people turn age 70 and a half. That's when you're forced to begin required minimum distributions.
Okay.
And coincidentally, the Social Security Administration tells us 70% of the people will begin to take money out of Social Security the first day they're eligible after they've stopped work. So if they retired at 60 and they can get it at 62, they turn on the tap, they start taking money.
Now, is that because they mentally think they just had to make up for the salary they're no longer receiving?
I can't. It's the way they justify it is the system may change. I may die.
Oh, that's true.
I want to get what I can get while I can get it before the government takes it away. All of these scare things. But in reality, what they should have been doing is probably using the money that was in the defined contribution plans, the 401ks, the 403bs, or if they did it on their own in their individual IRAs. Now, what we do know is that 70% of the money comes out, in my experience and opinion, comes out of your IRA and 401k when one of the spouses has passed away. So you're now no longer married filing jointly. You're filing as an individual. And so money that you were deferring perhaps at 10% up to $37,000, you're now withdrawing, but you can only get 18,000 out at 10% before you go to that next bracket. And
So
those
what's
things
the answer
change
to
all
that?
the time. Well, you be smart about when you use money. You pay attention to Roth opportunities and things of that nature.
Okay.
But this one is really about Social Security. There are two different strategies that we very often used inside of here, and I don't want you to think that the game has changed and there are no strategies left. Please do not go file for Social Security on your own. Dean Huddleston is our Social Security expert that we have in here. We send him to school once a year. We buy a sophisticated software program. They've already updated it for the changes that were made, and again, it came out of the budget deal. And there were two strategies that we would often encourage people and to get them to use. The way Social Security, just some key things, Sherry. If you've been married for longer than 10 years, at any time during your life, not currently, at any time during your life, you are eligible to either use all of your Social Security or half of your spouse or ex-spouses. I mean, again, you could be divorced or they could be deceased, whichever is greater.
Okay.
All of yours or half of theirs.
And I think when we talked about this before, people misunderstand that, and they think they're taking money away from their spouse or ex-spouse. In reality, they don't even know it, right?
If it's an ex-spouse, they have no idea that it even happened.
Wow.
You're proving there's a divorce and et cetera. So, and now in order to get that, I have to file at full retirement age. I have to file my Social Security. So, Barb's a chaplain at the jail, right? And I'm doing what I'm doing. And I have no intentions of retiring at 67 at my full retirement age. I'm 48 today. 20 years, things may change, but I have no intention. But before 2 weeks ago, what I would have done was at age 67, at my full retirement age, I would have filed and suspended. That means I filed, so Barb now is eligible for half my benefit, right, as my spouse. But suspending it means that I'm not going to take a check myself. Right?
Right, okay.
So that the money could continue to climb up until age 70. It never gets any bigger at age 70.
Right.
But my benefit would have continued to grow at about 8% per year up until age 70.
Okay.
All right. Now, the other thing that we use, and you can no longer file and suspend and the spouse take the money. You can still file and suspend, so you can change your mind, right?
Yeah.
But Barb would not, if I'm not taking it, Barb would not be able to take the benefit.
So before you could have filed and then suspended, but that would have enabled Barb to start taking half of what your number was.
At full retirement age, that's correct.
Okay.
Now, the other one was to file a restricted, and that's really crafty.
Okay.
That's when she would have, let's say Barb, we were fortunate enough that she was able to stay home with the girls, right? But let's say that Barb had worked and had a reasonable income, she could have filed on what's called a restricted application where she could have elected to take half of my benefit while letting hers continue to grow till age 70, and then at age 70 switching and to go back to her full one as opposed to the half one of mine. Great strategies, made lots and lots of sense. The New York Times reported, and you can read about this, by the way, on the Herald Bulletin. That's what my newspaper column was over last week. So if you want to read about it, you can find it in the Herald, or you can go to our website at yourlifeafterwork.com and go to FEG Insights, and it will be posted there. And if you can't find it, just shoot me an email. Consider this at yourlifeafterwork.com, and I will get the article to you. But the changes that came out were major. New York Times said this is a rarely used practice. Well, to the 380 of us that work with Ed Slott at the IRAhelp.com, I've been on Ed's board for I think 13 or 14 years now, and for those of us that saw that New York Times piece, that was a laugh because
you guys use it.
we use this strategy all of the time, and in concert with IRA planning and distribution planning and so forth. The government did say that it's about a $9 billion a year expense because of people who use that strategy. And so it was easy to put that money back into the budget. Obviously, it was a higher income, higher, financial level that used the strategy, and it got broad-based approval and was passed in no short order. So we went from having about 83, get a load of that, about 83 options for married people that have been married for more than 10 years, to somewhere down in the 60s.
For Social Security.
And that is just for your Social Security election. So I don't know if you remember or not, I said on a show earlier this year, we had a 61 and a 62-year-old that came in, and the difference between them taking Social Security, quote unquote, correctly and incorrectly was about $800,000 of lost income if they took it at 62 as they had both planned, as opposed to waiting to 70. $800,000 is a lot of money, my friend. So please be very cautious out there. Do not think that the rules are over or done. There are still various strategies that you can and should be employing inside of Social Security. And if you happen to be hearing this and you filed for Social Security in the last year, remember you have 12 months to make it all go away.
So call Joe. Yeah, seriously, call Joe.
I call it a cup of Joe. We can sit down and have a cup of coffee,
yes.
and Dean can run the software for you. But what really has to happen is Social Security is another one of those silos. Mm-hmm. And when I talk about a silo, we live in Indiana, folks. Drive down the road, you'll see them. They hold beans or they hold corn. And what happens to people in a financial situation so often is we get caught looking at our individual silo without thinking about the whole farm operation. Mm-hmm. You may have an IRA, your spouse may have an IRA, you may have a 401k, your spouse may have a 403b, you may have a joint retail account, and the money that Aunt Molly left you behind. Well, Social Security is one of those silos. And if we are going to successfully deal with the Internal Revenue Service, the one thing that separates most people from a happy retirement, if we're going to successfully deal with the IRS, we have to understand how to look at this as an entire operation, not just as standalone silos. Mm-hmm. And it can easily be put into concert, coordinated, so that you can get the job done. You can, what I like to call, land the plane successfully. But if you're not paying attention to taxes, if you're not implementing the right strategies, that you're setting the game against you.
See, I see that as a billboard.
That's a billboard.
Deal with the IRS successfully. Call the Financial Enhancement Group.
Well,
ask Big Joe.
If you've ever seen the billboard, it says "Retirement Made Simple."
I know,
because that's really what we try to do.
Yes, that's true.
It is. Hey, if you got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com. I got to take a break, but.
The definition of insanity is doing the same thing over and over again and hoping for a different result. Without tax planning during the year, that hope strategy simply won't work out. The Financial Enhancement Group can work with your CPA during the year to help minimize taxes in April by working with charitable gifting strategies, Roth conversions, and family transfers. The Financial Enhancement Group can improve your life after work. Call the Financial Enhancement Group at 800-928-4001. They can help you, and they welcome your call.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contost.
And we are going to continue on the conversation of defending yourself from the Internal Revenue Service. And no, this is not about how to get out of audits. It's not about anything tricky. It's about understanding your money. So, Sherry, darling.
Yes, sir.
If you believe that Social Security should be better explained,
I do.
Then you're really not going to like what I'm going to tell you about mutual funds.
No, probably not.
So if I ask you what a phantom capital gain is, do you have any clue, any idea?
Phantom capital gain?
Phantom capital gain.
Okay, I'm going to guess it means when you create on paper a capital gain, or the opposite.
Or the opposite.
Like you do something that would be at for your benefit.
Keyword you do something.
You, as in me, as a taxpayer.
As an individual.
Right. I do something that would be a benefit on my taxes on paper.
Would a capital gain be a benefit?
No, it should not be. It should not be. So phantom capital gain. Okay, so how about this? How about it's not a real capital gain, but the IRS says it is?
So I had a broker from one of the offices tell one of our family members that they didn't need to have the Financial Enhancement Group as a fiduciary because they had 10 fiduciaries. They had 10 different mutual funds.
Oh.
And each of those mutual funds, by law, the guy inside is indeed operating as a fiduciary.
Can't be.
Now, the question is, who is the fiduciary requirement for, right? So my job as a registered investment advisor is to be a legal acting fiduciary where I have to treat Sherry's money as if it were Joe's money and we were in the same situation, right?
Yes.
But I do that because I know you, I know about your life, I know about all your quote unquote silos. I know where all the bodies are buried and all the money's growing, right?
Right.
Inside of a mutual fund, I haven't met you. I'm not going to meet you. You send money in through a broker somewhere, right? Or maybe directly to Fidelity, whatever. And you send the money in, and I'm the manager of what's known as a trust, right? And I do, if I'm the mutual fund manager, I do indeed have fiduciary oversight and responsibility for that trust.
For the trust.
Not for Sherry,
right,
but for the trust. So if I say that go ahead.
Well, no, because it's the difference between, for instance, doing what's best for an entire country as opposed to doing what's best for an individual.
Exactly.
So, like, they have to do what's best for the trust, but almost by definition, that's not going to be best for every single person within that trust.
Of course not. Right?
Yeah.
So let's say that let's say that I'm a large cap manager, right? So you've got a prospectus and it says that this mutual fund is designed to buy large market capitalized companies. Now remember, market capitalization has nothing to do with the size of the company. It has to do with the current price of a share of stock times the number of shares that are outstanding.
Right.
So large cap means that you're buying companies with heavy market capitalization. And just to remind you, when you look at the 10 largest companies in the S&P 500, they control 20% plus of the whole move of the S&P 500. The 10 largest companies control more than the bottom 140.
But you're talking about dollars now.
Well, this time I'm talking about returns. Right?
Okay.
So if I'm a large cap manager, my job is to buy those biggest companies, if you will.
Right.
So let's say that I was a real smart money manager. And I bought Apple.
Yes.
Okay. And basis, by the way, is what you've paid for it with after-tax dollars. That's where you have basis. So even though this is still an issue, it's still something you need to be aware of. If you're using mutual funds inside of a 401k or an IRA, this doesn't impact you. This is money that you've got outside of that. Okay. And what happens is let's say that I'm the manager and I bought Apple at $69 a share, just as for instance, right? That's my basis. That's what all my clients paid for it that bought it, back in that wonderful time in 2008. Right, when the market went down. So $69 basis, but I own it in the trust. Sherry doesn't own the Apple stock. Sherry owns a unit of the trust.
Right, yeah.
And so every day, my job at the end of the day, as a fiduciary with our clients, is you're able to see exactly what you own, because I believe in transparency and independence.
Right.
Right. So you can see that I own Apple and here's what I paid for it.
Right.
In a mutual fund, what I'm going to give you is what's called the NAV, or the net asset value. And I'm going to tell you, here was the value of the unit of trust. Okay.
Which is made up of a number.
Which is made up of a bunch of different holdings.
Right. Yeah. Okay.
Once a quarter, I have to tell you what the 10 largest holdings are, but that's really, really all you know.
Okay.
So all of a sudden, you decide to put money into the market, and let's say that you pick the worst possible day this year, which is when the market was at its high, right? And you put money in, and then all of a sudden, we went through that really lousy September and the first part of October, right? Before the market turned around. And your neighbor, James, wanted his money out. He'd had enough. He thought that the White House was out of shape, Congress was out of shape, the debt was too high.
Yep.
He just wanted out. And so he called his broker and said, sell.
Sounds like me.
Now, Sherry bought into the mutual fund at the market high. right?
Yeah.
And now the market's gone down.
Yes.
Right? So on paper, you have, because you're the only one who can control the sale of that unit of the trust. Now on paper, what you have is called a capital loss.
Right.
It's unrecognized.
What I personally have.
Yes.
Right.
It's unrecognized. You bought, let's say when the unit trust was $10 a unit, and today it's $9.
Yes.
Right. So on paper, you have an unrecognized or unrealized, whichever way you want to look at it, capital loss on paper.
Right.
In the meantime, the mutual fund manager has to redeem your neighbor James. Mm-hmm. And he decides that he's going to lighten up on Apple. He may not be happy that Apple's starting to do the car thing.
Whatever.
It's too big of a position. So he sells Apple, which is about $120 a share today. Now, what was the trust basis?
So you said, what, 69?
69.
Yeah.
So in an individual situation, right, we would control that individually so that we would know what was going on Sherry's tax return.
Right.
In this case, because it's in the trust, the manager decides to sell Apple at 69.
Yeah.
Right.
Yeah.
The share price is 120. That is a $50 gain. Mm-hmm. Right. Now here's where it becomes a phantom. On paper, you have a unrealized or unrecognized loss on yours, but as far as the trust is concerned, it has a recognized capital gain. So they are going to distribute to you a phantom capital gain. You are literally going to pay long-term capital gains
on something
that you've owned for 2 weeks.
Oh wow!
Just because a broker decided to sell you a mutual fund near the end of the year. Now, in our office we're not a big fan of funds at all.
Nope.
If you've got less than $50,000, it's perhaps justifiable. If you have more than $50,000 and you're using mutual funds, it's because your broker likes his billfold more than he likes you. Just saying.
Tell us what you really think, Joe.
I will. I generally kind of put it out there.
Yeah.
Look, when we talk about these, the phantom capital gains, and our minds kind of get wrapped around what has happened in the past. Right.
Yeah.
And the recent past. And so very few people have seen these phantom capital gains because there were so many losses that were in 2008 that kind of carry forward and worked forward. Well, the market's done well.
Yeah.
Right? Most of those losses are gone. So we have things like the Oppenheimer Capital Appreciation Fund is estimating this year that its year-end distributions will be 13.07% of the net asset value. So if you have a $10 unit, if your NAV is $10, you're going to get a capital gain for $1.37. That's what they're telling you. T. Rowe Price funds estimate distributions ranging up to 15% of net asset value. Dreyfus, get a load of this, estimating as high as 20 to 25% of net asset value. So you've got a $100,000 portfolio at Dreyfus, you could be receiving a $20,000 to $25,000 long-term capital gain. So what do you do about this? Well, first thing is you become proactive, right? If you happen to have a loss inside of one of those funds where you have it's unrecognized, you bought it, it's gone down in value, you need to make sure that at least you sell it so that you can use that loss to try to offset the gain. A lot of people, when they use mutual funds, pay a commission. Remember, in most cases, within that family, so let's say you were at Dreyfus and you had a loss, but the gain was coming, you could actually move that money from one fund to another fund, typically inside of Dreyfus, without paying any sales charges. But it's still, from a tax standpoint, you would still be, quote unquote, recognizing or realizing the loss to be able to help offset.
Sounds messy to me.
Well, it is. It is. But again, we let people do things in this country that kill themselves slowly.
That's what
we just don't let people do things that kill themselves quickly. And I've never really understood that, but it is what it is. So a couple things you can do. there is a website called Cap Gains Valet, so CapGainsValet site. It's managed by a guy named Mark Wilson, and you can go there to look on the fund. There's no charge for using the site. However, they do ask that you make a donation to JDRF, which was formerly the Juvenile Diabetes Research Foundation. But you can type in your database, your QSIPs, your numbers or information, if you will, and it will give you an idea. BlackRock also maintains a database of over 7,000 funds. It's updated continuously as year-end distributions are announced. That's the one that we tend to go to be able to pull up this information to give you an idea of what is going to happen on your taxes.
What's coming.
Right.
Yeah.
And just like we talked about in earlier in the show, right? It's you've got to be smart about the tax planning part of this. You've got to be proactive. It has to happen before year end. Having this conversation with your advisor in March before you file your tax return is not helpful. It is a conversation that goes nowhere. This is something that you've got to do now. Be paying attention to now. We're getting ready to mail letters out to everybody in the families that we serve, reminding them that, hey, it is tax time. Not April. It is tax planning time. If there's something that's going on in your financial life that is a change, did you make a big donation? Do you want to make a big donation? Did you have any major health bill expenses that the insurance company didn't cover? Did your income happen to fall, or did it go up? Did somebody in your family pass away where you may now have an inherited IRA that you have to deal with and need to make sure the distributions? We're going to ask those kind of thought-provoking questions so that we can do the right thing on side of your tax return. Sherry, I've said this on the show before. The majority of the time, I pay the fee that we charge to manage money off of people's tax returns the first couple of years. Just basic strategies that we're able to employ to help people better deal with the IRS and better understand their retirement.
That's great.
Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. Hope you're having a great day. You got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com. I'll take a break.
Consider This with Big Joe Clark is brought to you by the Financial Enhancement Group, a Hoosier-based registered investment advisory with more than $150 million under management. The Financial Enhancement Group serves clients in 25 states and proudly takes care of people who don't want to worry about their own money. You can find out more about the Financial Enhancement Group at yourlifeafterwork.com or reach any one of our 4 Central Indiana offices at 1-800-928-4001. Your Life After Work. That's what it's all about.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Angie Kinzer.
We are so happy to have you along. It's a true honor. We're sitting here toward the end of October. Always an interesting time. Ange, I love the leaves.
Me too.
I got to spend some time in Denver, Colorado, which is not too bad on its own, but was not near this pretty. I'm part of the Ed Slott IRA Help Group, and if you want to know more about IRAs or anything IRA, you can always go to their website at irahelp.com. I've been on Ed's board for 13 years now. There's about 390 of us that talk tax, and that's our thing. So it's about a third CPAs, a third of people that are in the financial services industry, and another third that are kind of a hybrid of those two that are put together. A few tax attorneys, and we sit down and we discuss tax. But I got to fly in Sunday, missing the Colts game, which was not a bad plan.
I bet that was gorgeous, though, flying in.
Oh, the leaves were perhaps the prettiest that I've ever seen. And so this season represents a lot for us. I love Thanksgiving. I love Easter, but I love Thanksgiving because it brings all the family together. I love the leaves changing, but what it does is, from a market perspective, is it changes that period of time from where we go into a seasonality of market challenges to a seasonality of market success, right? Now, seasonality is not a perfect thing. We know, living in Indiana, there are days where you wake up and it's 80 degrees in December. We don't know why, but it just happens. There are also 40-day degrees in August every now and then. We saw, I think, one of those this year. So, weird things can happen. But from a seasonality standpoint, Angie, there's an old expression that says sell in May and go away, and people always say, well, when do you come back? Right? When do you revisit? And that answer tends to be sometime around November 1st. The market between the beginning of November and the end of April tends to have the extreme majority of its growth. As much as 70% of the entire market positive performance for the year actually does tend to occur to that. Now, we just lived through this last week. I got to live through one of them. But we call them Black Mondays or crashes, if you will, inside of the market. The original Black Monday, that we deal with happened back in 1929. Obviously, I was not part of that one, but I was very much a part of the one in October 19th of 1987. And like I said, we just passed that period of time. It fell 20.5% in one single solid day. It was the largest single drop in the history of the index. Now, the market actually fell a little bit more, but when we talk about the S&P 500, what I want you guys to remember is it's 500 companies. It was designed to be able to be an economic instrument to pay attention to what was going on in businesses around the United States. The theory was that in our economic times that we have a period where you have a peak in an economic cycle where things are going really, really well. Eventually, things start to slow down and you go into a contraction. And then eventually you wind up in that R word, the recession. Eventually, things get better and you expand, or what we would call an expansion. But you would move around this clock, if you would, going through this economic cycle. And so Standard & Poor's was contracted, if you will, to put together this group of companies so that under the belief, the thought process that utilities would perform when the economy was perhaps weaker and getting weaker, whereas an industrial or a technology company would perform better when things were improving between the peak and between the expansion and the peak. And so it was never designed to be invested in. That was a John Bogle idea back in the 70s. And, it made him a billionaire. It worked out well for him. But I think sometimes it confuses people. So we end up talking about both the economy and the market. And just to give you some comparisons and some contrast of what's going on right now, when we look at it, one of the things that concerns my allocation team, we manage money. If you're not familiar with the Financial Enhancement Group, we're registered investment advisors. We've got more than $200 million that we manage for clients in more than 20 states. And so it's our job to figure out where your money belongs based on the economic cycle and the time that we're in today. And so when you hear me talk about making changes, they're not changes that I'm necessarily saying that you should go make on your own. They're changes that we make for people in the most tax-efficient and cost-efficient manner inside of our offices as legal fiduciaries, where we're obligated to treat your money as if it were ours and we were in the same situation. So when we look at the market perspective, we do this show early in the week, and then you may hear it on Thursday on WILO, between 4 and 5 on dry time. It may be Halloween morning on Saturday the 31st for you from 9 to 10 right here in WQME, or Sunday morning on Shine 99 between 10 and 11 a.m. But when you're hearing it, understand I'm talking about what's getting ready to occur over the end of the month of October. That's why I brought up the history of October 19th and the Black Monday. So the Friday before this, the previous Friday, we woke up one morning and the technology companies, the large cap, we're going to get into that in a second, just blew everything out of the water, Sherry. We watched Google, Amazon, and Microsoft all up more than 10% in after-hours trading on Thursday. All three opened up at 8.5% better on Friday morning. And so when you saw the statements or you saw the market, it was kind of like wow, this is a good day, right? Now, when we talk about that S&P 500, think about the fact that we're talking about an index. It's 500 companies, but it's based on what's called market capitalization. So market capitalization is when you have one share of a company's stock times the current price times the number of outstanding shares, the shares that are available for sale. So you can only have 100%, right? I mean, percent's a percent. 100% of my company, 100% of your company, you only have 100%. But when you look at companies like General Electric or Microsoft, there's as many as 10 billion shares of stock that are outstanding. When you look at a Harley Davidson, for instance, there may be as little as 300 million. They both represent 100%, but just looking at the share price doesn't tell you anything. So when we looked back last Friday, everything on the outside of the car looked really, really good. There was no rust. I mean, that puppy was up. But when you opened the hood, what you found was that the markets actually had one of the weakest days for what we call breadth or participation in the market, one of the weakest days on an up day ever recorded in history. And it was because the large cap companies performed so well that it made the littler companies kind of get ignored when you looked at the index. When you looked at the S&P 500, wow, it was a great day. But it just really wasn't such a great, spectacular day when we look at it from breadth. And that is very concerning. Now, is this a forewarning of bad things to come? Well, it might be, but it might not be. What we're watching inside of the Financial Enhancement Group is that breadth number and the relative strength number, the momentum, if you will, of the market. And eventually they have to go in the same direction. Now, as they've said for years and years and years, markets can remain wrong longer than you can remain financially solvent. So this is not something that says, hey, you have to go take action today. But it is something that ought to lift your eyebrow, if you will. Now, it was an interesting thing that came out of Bloomberg earlier this year. It said the U.S. now has more publicly listed companies, more publicly traded companies on the exchanges than it did in its peak back in 1996. Now, what does that tell us? Well, when we take a company and we go public, right? And believe me, many of the best companies in the country really are not publicly traded. You don't know their earnings. You don't know what's going on in the world because they did need capital. And if I'm going to take a company public, if I'm going to be publicly traded, I expose myself to the Securities and Exchange Commission. I have to deal with all the reporting that says, hey, this is what's going on inside of the company. I've got to do earnings calls. And I've got to deal with people who are out for my job if I don't make stock prices go up in the short term, right? So when you go public, when you do an initial public offering, you expect some sorts of results to occur, something to be able to be out there to make a difference in stock price, if you will. Now, when I, as the CEO or the owner of the company, decide I want to do an IPO, it's usually for one of two reasons. Either I've got all of my wealth tied up in a company. So think Zuckerberg at Facebook, right? I've either got all of my wealth tied up and the financial planner says, you know what, you really need to diversify. And one of the best ways to do that is go public, right? Or I need capital. When Harley Davidson went public back in 1987, it's because it needed capital. It had to be able to take some of its assets, trade it in for cash so that it could continue to run its plants and build its motorcycles and do its things, right? The third time when it happens is when, in my opinion, you're getting ready to take advantage of people because you believe market valuations happen to be very, very high. And when we look at what's going on in the economic world right now, remember I told you in the beginning of this, there's a difference between a market and an economy. One of the things that we'll talk about this week in multiple occasions is the strength of the dollar. Remember, if you're a company that imports, you want a strong U.S. currency. If you're a company that exports, you really would prefer to have a weaker currency. So a lot of our big companies, Apple, for instance, makes more money overseas than it does here at home, right? So it has a headwind, if you will, quote unquote, a headwind against it when the value of the dollar is this strong. So when we look at the market last week, we talked about the breadth and the performance. The large cap companies actually did the best from a stock standpoint price. But earnings of companies are coming out. And the earnings in the mid-cap and small-cap companies right now tend to be stronger than in the large cap. And that's because most mid-size and small companies deal domestically just here in the United States, don't deal as much with that international marketplace and some of the I don't want to say challenges, but some of the different risks that you have to deal with when you're dealing in a foreign world. You know, it's just part of the process of being able to look at it. Now, later in today's show, we're going to talk about when it's time
for you to make changes, when it's time for you to look at your portfolio, some of the considerations that you should make about, okay, maybe now it's time to relook at things. Angie, you've heard me on multiple occasions say I married Barb, I date my stocks, and there's a reason for that. I think it's very easy for us to get emotionally attached to what a stock has done for us in the past. And the company that I've always used in the past when I talk about it is Harley Davidson. I love the story. I loved the bikes. I loved the people that I was around all the time. But there was a point in time when, from a standpoint of future growth, that company began to break down, and that's when I had to part with the stock. And over the last 8 or 9 years, I've had people come up and say, Joe, I knew you were wrong. The stock price went back up. And it also has gone back down now. And it's, when you miss earnings, bad things just start to happen. We want to be able to invest in things that make sense in our portfolio for a longest period of time as possible. But when change occurs, it's important that you be prepared to make those changes as well. Hey, you're listening to Consider This. I'm Joe Clark along with Angie Kinzer. Got to take a break. We'll be right back. If you got a question or comment, though, shoot me an email. Consider this at yourlifeafterwork.com. We'll be right back.
Are you overwhelmed with financial complexity? Are you confused about how your 401k and your IRAs work together? If so, you're not alone. At the Financial Enhancement Group, we work to make your financial life simple. On a single sheet of paper we call the Family Focus page, we help you lay out your long-term financial objective with the next 36-month key financial objectives. At the Financial Enhancement Group, we keep it simple. We keep you on track. We work together. 800-928-4001. We look forward to hearing from you.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
And I'm Angie Kinzer.
And we are so happy to have you along, Angie. Appreciated your time today. I remember in our childhood this show called The Bad News Bears.
Yes.
And do you remember the thing that they put up on the board and said, assumptions can lead to problems, and they drew the line between the words and said, yeah. And I think we all remember that. Every now and then I'll make reference to that to somebody and they have no idea what I'm talking about, but I would strongly encourage you to go back and see the Bad News Bears, which probably had to be late 70s, maybe 75, 76, somewhere in there. I think.
Great Walter Matthau.
It was a great,
Yes.
You got to love Matthau, the grumpy old men and the whole bit, but anyhow, here's the point. We're getting ready to move into that world where we're talking about, do I have enough? And that's the big, honest, genuine question that, when you put as Tobias would say, the moose on the table. When people walk in, they go, Joe, number one, do I have enough money to retire? Number two, how do I make sure that you're not going to lose it? And number three, how does this all work out so it's in both of our best interest? If I could summarize all three of those for people, and make it simple, that would probably be the gist of the conversation. You may add why you, not somebody else, but the big one is, do I have enough? And those are great questions, and they're based on a series of assumptions, and assumptions are going to be wrong. They just are. What I try to do with retirement planning, what we call landing the plane or distribution planning, is helping people make sure that they truly understand the distribution impact. So one of the things that I use in an illustration, for instance, is I will ask people, what is their expected rate of return? And people will give me a number. Now, academically, I'm taught a professor at Purdue for 7 years. I'm taught to think about this in the world of large numbers. Right? So I'll ask you what you expect your rate of return to be. And people will say, well, 4% or 5% or 6%. It's okay. That's fine. Not 8, not 12. You come up with what that number is. Now, academically, where do they get that 4, 5, or 6% number? And what we do academically, again, is take all of this stuff historically, look at where the returns were for bonds, look at where the returns were for stocks, and help you come up with a portfolio that matches historically that mathematical return, right? And then academically, everything ought to work out. We can even use some cute words like stochastic modeling or Monte Carlo simulation to show you what percentage of success that you have. So one of the things that I like to show people, and we call it the FEG difference. If you ever looked at one of our statements, what you're going to find is I show you the 1 year return of your portfolio because I have to. What you also get, though, is what your average 12-month return has been since the day you became a client, right? That shows all of the fees, expenses, contributions, withdrawals, all of the money going back. So you can see what that return was each and every year, plus what your average return was. And what I like to show is an average return. One of our families, it's 7.73%. They were a balanced investor. That's net of fees and expenses. That's their average return for the last 12, or since the end of 2008, if you will. That's their average 12-month return. And so I put it up on the board, and so what do you suppose they could assume that they could take out on an annual basis and be okay? And the average person's going to say, well, Joe, if that's what their average return has been over a 12-month period of time, for that many years, they could probably take that amount of money. And the answer is, that's not how math works. That is not how math works. That is too large of a drawdown. If you think about it, markets go up and down. Now, as I like to tell you, the IRS rarely sends a check back. Nothing will separate you from your retirement like the IRS. But when you're looking at the market going up and down, and you're in a preservation stage where you're not using your money, it's frustrating, but it doesn't kill you. It just goes up and down, and then your average return truly does matter. You can start at the beginning, as long as you're there all the way through the middle, and you're there in the end, then average return counts. On the other hand, when I'm taking money out of an account, so out of a 403b, out of a 401k, out of an IRA, I'm taking distributions to be able to maintain your standard of living, to be able to give you the money that you need. If you take that money down and the market's down, it doesn't get a chance to go back up, right? It doesn't get there. You can have the same average return over the 8 or 9 year period of time and still be dead flat broke at the end of the day or have eaten into principal. So it's not as simple as looking at a static rate of return. I'm an academic. I'm a certified financial planner. I am trained to talk to you in the law of large numbers. But for 27 years, I've been a financial planner. And my job is to look at you and help you understand that you are unique. God created you uniquely. Your journey with your spouse, with your kids, with your community is unique. And if we don't take into consideration the uniqueness of your life expectancy, the uniqueness of the assets that you've saved, the uniqueness of the standard of living to which you've become accustomed, if we don't look at all of that and put it into an effective model, then there's no way that the academic research is going to do a darn bit of good for you any more than any of the simulations that we try to run in the academic world to give you assurances of whether or not those three things are going to happen. Do you have enough? Is it going to run out? And how do we protect it? So what do we do? Well, again, at the Financial Enhancement Group, we help make sure that you understand that it is truly a journey, not a snapshot. That's why we show you those long-term periods of returns and the results of what's really happened with asset management and the tax planning along the way. Secondly, we would help you break it into a couple different things. The first one is you need to come up with a budget that says this is what it costs for us to maintain our standard of living. Us, your spouse, if it's just you. But this is what it costs for you monthly to be able to maintain your standard of living. Secondly, I'm going to ask you to break that down into what is a fixed expense that you're still going to be doing today and tomorrow and when you're 95. I'm also going to have you break it down into a social expense. What is it you're spending money on today that you really, really enjoy, but you know you're not going to be able to do it forever based on health or age or whatever else is out there? And then once we do that, we're going to sit down and we're going to do two things. The first one is we're going to maximize your tax bracket. So we're going to look at the income that you have coming in, and we're going to say, okay, how do I maximize those marginal steps that we talked about earlier in the show? How do I make sure that they're maximized where I keep you from a tax perspective in those first two steps on the stair step? And then how do I use after-tax or tax-free money to be able to subsidize the rest if necessary to be able to get it done? So we're going to maximize that tax bracket. But most importantly, we're going to have a 3-year deal where, Angie, I'm going to look at you and I'm going to go, okay, it's time. You can finally retire now. And you're going to have a $3,000 a month income, or $4,000 or $8,000 or $12,000, whatever it is, whatever that plan is. And we're going to do that for the next 3 years, regardless of what happens to market performance, regardless of what happens positively or negatively. And the reason I say that is I did this during the tech wreck. I did this in the late 90s where people took out money and still watched accounts double. And so they thought they could take out more money. And now they've wound up with huge problems because there was a tech wreck. There was a 2002. I've also watched people in 2008 destroy their lives and decide that they couldn't afford to spend what they were spending because the market had an absolute collapse. And that wasn't right either. You got to give the market time to do its job. So we stay on 3 years. And what I did with our people in 08 and 09 was say, listen, 3 years from now, we may have to make an adjustment. But let's look and see what happens over the next 3 years first. Let's be very, very smart about this. Understand that it is a journey. It is not a snapshot. I have lived through the crash of 87. I've lived through the recession in 91, the tech wreck, 2002, which is probably the worst year ever, 2008, which most of you can remember. We have lived through this volatility. We understand how to manage that, how to be able to deal with it. But it's time for some of us to be able to retire, and we just need to have a better understanding of our money, understand what some of those assumptions are, that they're never going to be right, but let's figure out the best way to possibly circumvent them so we can get them in the right shape and give you the best chance to have that retirement that you want and a successful future going forward. Hey, you're listening to Consider This. I'm Joe Clark along with Angie Kinzer. I got to take a break, but if you've got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com.
Leaving a legacy is more than just leaving behind assets. It's leaving memories, values, and life lessons. The Financial Enhancement Group helps families work with their attorneys and their heirs to make sure everyone is on the same page and that your goals are being met. Communication, clarity, and attention to tax code changes are the keys to truly passing on what matters most. The Financial Enhancement Group can help make your wishes come first. Call the Financial Enhancement Group at 800-928-4001. They can help, and they welcome your call.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Sports fans, I like to tell people that things change. And, when it comes to taxes and investing and everything else, things just change. Mm-hmm. Things also happen. And when they happen, you just kind of have to deal with them. And, one of the 5 critical elements that we talk about here on the show, your life after work is that retirement. The tax planning is something that has to happen every year. The investment playbook is dealing with the risk and volatility of the markets. The last one is legacy planning, what you want to leave behind, which is more than just money. But there's also that one in the middle. It's just life happens, and that's dealing with the good and the bad and the ugly of life. And I want to thank everybody publicly for the prayers and the support and from this last week. We were moving my daughter home from IUPUI down in Indianapolis, and my wife and Kendra's friend were upstairs. They looked down, and there was a man talking to Kendra in the truck, and Barb went down to investigate. The guy had a gun on Kendra.
Oh my gosh.
And took them for an hour-long ride at gunpoint.
Oh my gosh!
Stole the truck. Threatened to cut Barb's finger off to get the wedding ring. So she finally got it off and took the phones. So my shout out goes to the police. The Metro Police were very, very good in helping once they found Barb, and they dropped him off in a vacant apartment complex in Brightwood in Indianapolis.
Wow.
They made their walk to the Family Dollar. The people there helped with the phones. The police were more than gracious. As they say, nothing was hurt and everybody is safe. But if you've ever been a victim of something like this, you know that that's not necessarily true on the inside. And I very much appreciate the thoughts and the prayers, the wonderful comments, and the support, the offers for bounty hunters.
Yeah.
Those kind of things. So,
wow.
Anyhow,
so sorry, Joe.
just wanted to say thanks. Fox News reported the story. They had most of it accurate, but
wow.
It's a very personal thing. At the same time, it's I don't live a private life, so the news gets out, and I want you to hear really what had happened. So, with that, I appreciate your support. And if you've got questions or comments or things about the show that you want to share or questions that you want us to talk about on the radio, feel free to send them. You can email me at considerthis@yourlifeafterwork.com. Folks, God bless. Have a great week. We'll see you again soon.
Thanks for listening to Consider This with Big Joe Clark. Big Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group is located at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com. Have a great week, and don't forget to consider this.